So we are on the last part of the standard, okay, so which is reverse acquisition, which is a very new thing in Indians, which is never heard in accounting standards and all. So let us understand what is reverse acquisition accounting, because we have got a purchase acquisition, common pooling of interest method, and reverse acquisition method. Only three things. That depends upon the acquirer. Who is the acquirer? See, when I was small, I always heard one song, okay. I never understood what this song is all about. Have you heard about this song? Kodagana Koliningvita. Do you know what do you mean by Kodaga? Kodaga means a monkey. A hen swallowed a monkey, it seems. And a goat swallowed elephant, it seems. I did not understood only for a quite long time. One more song I heard. Okay, Purandaradasa did this song. It's called this Mullu Mone Amele. That means on the tip of this thorn, no, somebody constructed 3 lakes, it seems. And 3 lakes. Mullu Mone Amele, Muru Kere Katti. I always wondered, what is this? Like how it's possible that on the tip of a thorn, somebody can construct 3 lakes? Meaningless, no? A goat is swallowing elephant. Then I understood they are talking about reverse acquisition. After I completed this Ind AS 103. See, if you see, you know how many neurons we have got in our mind? 8,600 crore neurons are there in every person, almost healthy person's mind. Every one of us has that. 8,600 means every neuron has got one piece of information, something is there. See, imagine, no? One spark happens in one of the neuron. We can call it a spark of confidence. A neuron is so small that you cannot see. In our brain, 8,600 crore. And that spark of confidence, no, swallows you fully. Is it not a reverse acquisition? And then you take a lead, you take risk in your life, you do so many things, and ultimately you do something which is unimaginable. And this is I call a reverse thing, which is not even, you cannot see something. Take something big thing, swallow something big thing. This can happen only in our life here in this world. See, there is one company, I'll explain you from our company perspective. The name of the company is called Bollinger Limited. And there is another company called Anjal Limited. You know who is Bollinger and Anjal? Okay, Bollinger means a very small fish like this, silver fish. Anjal means what you call kingfish, no? You know this? Kingfish, right? Yeah, okay, name it any fish. Kingfish is so big. Silver fish is so small. Can ever silver fish swallow kingfish? No. But it can happen, I don't know. When a hen can swallow a monkey, why not a silver fish can swallow a kingfish? How it will happen? Kingfish means here companies I'm talking. It is like, I will set up 36 chamber. Next day headline comes in every single paper that 36 chamber has acquired Reliance Industries Limited. Nice, no? Can it happen? Yeah, it can happen. How that works, you see. Now, they acquire this company. In return, they will not give cash. They will give the shares. How much? For every single share, this company issue, it's 10 shares. It's a complete swap ratio, share swap. Now, before that, there was one guy called Xi Jinping, who was holding 80% stake in Anjal Limited. Now, after this swap, this person started to hold 80% in Bollinger Limited. That means the acquirer himself gets acquired by the owner of the acquiry. And everything goes with this particular thing. What did you offer? That's why in one of the questions we said that post-acquisition, the owners of this, they were holding only 5%. That means the acquirer himself retained control over its entity. You didn't give up to the acquiry. That's why in this type of situations, we come across one terminology called a legal acquirer, who This guy, legal acquiry, because everywhere MCA, ROC, court, your GST registration, everywhere they legally recognize Bollinger as the acquirer. Who has to prepare CFS? Bollinger Limited has to prepare CFS. Anjal is only a subsidiary. But when it comes to accounting, see, we can very clearly see you're trying to fool Baba. You're fooling around people there. Do it legally. Let that legal stop you. But from accounting point of view, I'm going to stop it. How? Simple. I will treat you as acquirer only. I will not permit that simply because you have changed one legal phase. I'll not allow you to account it the way you want. Because in this process, what happened? No. These people take over this at a fair value. And Bollinger Limited's financial statement will be at a book value. But because of the reverse acquisition, and I will treat them as an accounting acquirer, when you prepare CFS, you have to take book value of the acquiree, fair value of the acquirer, ulta, reverse acquisition or reverse accounting, finish. That's it. Simple. Simple, no? See, because who is the owner of Anjal? Okay, we'll say B and A. Who is the owner of A? Jinping, because he is holding 80%. Now, after acquisition, who is the owner of A? B Limited. Who is the owner of B? Jinping. Now, is it a common combination? If Jinping himself holds here, then it is a common combination. That's why by default then you have to take a book values only. No headache of fair value. But if this guy was totally different, who was not within the control of this Jinping, then this becomes a reverse acquisition case. Because there is a very thin line between common combination and reverse acquisition. Okay, so we'll discuss some theory, accounting part, how to solve this, what is the accounting principles. See, reverse acquisition is the case when an entity issues its securities, whom we call legal acquirer, is identified as an acquiree for accounting purpose only. Legally there will acquirer, but they are accounting acquiree. When a small limited acquires a big limited, something like the 10:1 ratio. Generally should have been 1:10 ratio. Who will issue more shares than who want to lose the control? Generally, acquirer will issue less number of his shares so that he will retain the control over his business. But after acquisition, the owners of big limited will start controlling small limited. Now that's why we have got 4 concepts now, 4 new terminologies comes. Now this can take another form called acquisition involving shell companies. Now reverse acquisition sometimes occurs when a large private company wants to become public entity. Why? Because I want money. So from where do I get money? I will get money from USA. Or say for example, I want to raise the money through stock exchange in India. But if I go to the stock exchange, they say that, okay, there is very strict regulations for me. Quarterly reporting, this, that, so many things they will come. You have to get yourself audited. Who is your owner? They will not permit me to get listed so easily. Because getting listed means getting money from the public. So what I can do, if I don't want to list myself, who does not want to register its equity shares in the public, they can get the money from the public by arranging a small public company to acquire its equity interest. We will see there are so many penny stock companies listed in the stock exchange who are just listed for namesake there. Their shares are not traded only. What I will do, I will make that company to acquire me and I will prepare one CFS. Now that company becomes very strong and powerful because that is the parent company. No? Now parent company comes with an IPO or FPO. It will collect the money from the parent, from the general public, and hand it over to the private subsidiary. Interest-free loan. 109 we have learned that this type of things we are going to track that, but this is what people did. They don't want to list because they are subject to regulations, so they made and in fact, see, it was told from 2010 to 2014 around 200 companies in USA got listed, Chinese companies. Out of that, 80% are reverse takeover. That means, see, Chinese company, they are looked very suspiciously in USA. So what they did, they US companies only, which are listed in USA, they made them to acquire one Mauritius company. Mauritius company acquired one Chinese company. Chinese companies acquired this subsidiary, like a chain of acquisitions. And ultimately, that US company will prepare one CFS, which will show its subsidiary also. There are restrictions, students. More than 2 layers, you cannot have any subsidiary. We'll discuss that in 110. Because people will nicely use this legal structure to take advantage. You don't know where the money is coming from, where the money is flowing. Audit has become so complex today because structures are so complex. So the public entity becomes the legal acquirer, and it is a sham company. It is a one namesake. It is a dormant. It is not working only. But just because it acquired, it became very powerful. Its balance sheet became powerful. Which one? Not standalone, the consolidated. But the owner of the subsidiary is the owner of that public sham company. So private company is the legal acquirer. Are you very clear about the what do you mean by reverse acquisition? Yes, the accounting of reverse acquisition is only simple. Net assets of the legal acquirer is taken at a fair value. Acquiry is taken at a book value. Ulta, reverse. Reverse of legal acquirer, reserves of legal acquirer is ignored. But reserves of legal acquiry is taken as it is, which doesn't happen. We never took the reserves, no. We always took the net assets of the acquiry. But here, reserves of the acquiry will come, share capital of the acquiry will come. But the problem is the share capital of the acquirer comes with a different structure. I'll show you. It is not even the share capital of the acquiry here. Reserves of the legal acquiry is maintained, but the goodwill is also computed here. Followed, no? Yeah, we will solve some problems. Then you appreciate how exactly this works. Only one question has come out of 3 questions in the examination. Yes, take out question number 35. A very famous question called AX, BX and ABX. AX Limited and BX Limited amalgamated on 1st of January 2002. A new company called ABX Limited with the shares of 10 each was formed to take over the business of both the companies. No, that ABX is only for a namesake, no. Now, who is acquirer here? You will say, sir, ABX is the acquirer. Who is the acquiree? AX and BX are the acquirees. But how can a new company can take over 2 companies? It's not possible. No, that means one among, it's like a Veera and Zira example. Someone among AX or BX is so powerful, they acquired another entity in the name of ABX. Now, who is that? That you need to find out. Now, they have given you the property, plant and equipment, inventory, etc. Equity share capital they have given, borrowings they have given, trade payables. They have given you the balance of the reserves of both the people, because one of the reserves you have to take now. Now, ABX issued a requisite number of shares. They didn't tell you how much, because this is one of the major calculation involved in reverse acquisition, for which you get a flavor of your mergers and acquisition chapter of AFM. Calculation of the purchase consideration, swap ratio, business valuation, one concept comes here. And they to discharge the claims of the shareholders of the transferor company. So they told that, look, ABX issued its own shares to both the members, AX also, BX also. How much? They didn't tell. Also, the new debentures were issued in exchange of old debentures. So there were some old debentures, new was issued, no accounting implications. Now prepare a note showing purchase consideration, which is the crux of this, and discharge thereof, and the draft balance sheet of ABX Limited. Now they give you 2 scenarios. assuming both the entities are under common control. So you have to treat it like a common control, pooling of interest method. Simple. We have already done that. But we have done it as a restructure with the division, demerger and all. This case, amalgamation we are going to work on with the common combination. Second, assuming BX is a larger entity and their management will take over control of ABX. How can acquiree can take over control of the acquirer? That means BX must have acquired AX through ABX. So who is the acquiree here? Okay, then you should ask me which acquiree? Accounting acquiree. ABX doesn't come into picture only, no, Baba, because ABX doesn't have a balance sheet. Where is the balance sheet of ABX? If they would have given you a balance sheet of ABX, then you would have told, sir, there are two acquirees, one acquirer, because acquirer can be only one. BX is the acquirer in substance, say accounting wise. Who is your accounting acquiree? AX. ABX also. But ABX doesn't have any balance sheet, no. So just ignore ABX now for time being. So you have to prepare one consolidated balance sheet in the name of ABX. Name is only ABX there. Shop name is ABX. Who is running the shop? BX is running by taking over AX. So you have to do this reverse this accounting as if BX acquired AX. Simple, no? What is the headache there? You have to do this accounting as if BX acquired AX. So fair values of PP you should take, you have to calculate the goodwill and you take the book value of the BX, finish. Who told difficult? Have you heard somebody telling difficult? No. If somebody tells for reverse acquisition is difficult, you ask them what is the difficulty? Simple. Reverse, no? Okay, so we'll solve this. First thing, see, there is one guy called X who controls AX and BX. Now, they form an ABX and ABX will issue its shares to the owners of X. Correct, no? Have you understood this structure? See, today's day, in this person's share certificate, whose name is there? X. This certificate, X. Now, this person will sell his shares to a new company called ABX. In this company shares now, whose name is there? ABX. This share certificate, whose name is there? ABX. In this company share certificate, whose name is there? X. So previously you are directly controlling. Now through ABX you control these two people. Now is it a reverse acquisition? No, it is common combination. Why? Because before acquisition also, after acquisition of also, both acquirer and acquiree is controlled by the same ultimate person. So you have, that's why first part of the question, that's what I told you, it's a very thin line now. Who is controlling acquirer and acquiree before? That's why same question they included both, common combination also, reverse acquisition. But this is a common combination. But what is reverse acquisition? Okay, in theory we discussed now, all things in the chart I have told. AX was controlled by Mr. A. BX was controlled by Mr. X. Previously in their share certificate, A's name was there, X name was there. Now, A certificate ABX will come in both the people. Here, ABX is controlled by two set of people, X and A. X will have say 60%, A will have 40%. Now, who is controlling? X. Is it a common combination? No. Why? Because one of the acquiree before combination was totally controlled by the other person who is other than X. Perfect? That's why this becomes reverse acquisition. For these two people, it is common combination. Understand? And for these, it is reverse acquisition. Yes, first write the solution, calculation of the purchase consideration. This combination is normal. That's what, no, that's why we take the fair value of this and book value of this. That's what I'm telling you. But when you take all together, now who is acquiring whom? In the name of, forget AX, BX acquires AX, no, through ABX. That's why when we look into accounting, it is like two combinations we need to do. For one, we have to apply normal combination at a fair value. Another, we have to apply common combination, which is at the book value. So ultimately, we will take the book value of this, fair value of this. If this was not there, what we would have done? If index was not there, if this we should follow under accounting standard, what you would have done? You would have taken fair value for both. You would have taken fair value, no, because both are in both different parties. I don't know how this concept has been discussed there, because at least I don't remember all these things discussing during my accounting standard era. Anyhow, I don't want to get into also, but I'm telling you, if these provisions were not there, you would have valued both the people at a fair value. But this is a common combination. How can you value at a fair value? How can you calculate goodwill by dealing with yourself? Goodwill come only for this particular combination. Yes, calculation of the purchase consideration, right? Okay, write the heading common control. First part. There are two questions they asked, no? One is common control, another is the reverse acquisition. So first we will write about the common control. And they asked prepare a note calculating purchase consideration. So I will follow one shortcut here. I will show you ICA method also, what they have done. Since it's a common combination, what is my net assets at the book value of AX? Can you tell me what is the net assets of, 9,050. BX 9,700. Since we have to maintain the reserves also, less other equity, because we have to maintain the status of the reserves. In common combination, we have to take the reserves as it is. So ultimately we pay for the equity only. So I say total purchase consideration is 6,000, 7,000. That's it. Clear? Now, how ICA has done this? You see, you do this, leave some space if this question comes in the exam, because ICA has taken over individual assets like this to calculate the purchase consideration at the book value. They prepared a statement. They said that, look, my net assets is 9,050, 9,700, which I showed here. They gave the breakup of that. And the equity reserves and all, they deducted it. And they said the purchase consideration is 6,000 and 7,000, total 13,000. Followed, no? But this is going to kill your time there in the examination. So strategy should be, do that working. Below that, leave some space. At the end, if you could not come, strike this. Strike that blank space. No, you get a time. You do this working and then strike the previous workings. Followed, no? Yes. Next, we need to distribute now. Discharge, second, discharge, because they asked you prepare a note showing calculation of the purchase consideration and discharge of the purchase consideration. So we calculated the purchase consideration. Second, discharge. How do you discharge? What should be the basis to discharge the purchase consideration between two people? Net assets. Generally, we distribute, if it is a common combination, based on the net assets we distribute. First of all, what is your purchase consideration? Net asset is your purchase consideration, no? So you discharge this particular purchase consideration, total purchase consideration of 13,000 based on the net assets of these two entities. Because you have to take everything at a book value, nothing fair value consideration you should not do. Okay, one thing I forgot to discuss here in the question. They have told you here fair value of the net assets, 9,500 inventory, and the fair value of the business as a whole. This we require for reverse acquisition, not now. Because fair value, and I told you, common combination, where is the business fair value, business acquisition? The last sentence. Because straight away I started to discuss about the reverse acquisition. So for the first part of the question, this fair valuation, business valuation doesn't come into picture. Clear, no? Everything happens based on the net values, net assets. Common combination means take the balance sheet, as per the balance sheet distribution should happen. Are you clear? Okay, so first we calculated the purchase consideration, then we have to discharge it. Okay, how do you discharge it? AX Limited, write the heading, discharge of total rupees 13,000. How did you get 13,000? That previously we calculated 6,000 plus 7,000. Allocation based on net assets. So how much you give to AX? 13,000 into 9,050 net assets of AX divided by 18,750. So you give 6275. And for BX, 13,000 into 9,700 divided by 18,750, you get 6725. Understood, students? Beautiful numbers, sir. 6275, 6725. Be careful. And common combination says the shares are issued at a nominal value, face value. You cannot issue shares at your book value, market price. That market price issue, purchase consideration, issue of market price happens only for your normal combinations. So what is your face value of the shares? 10. So how many number of ABX shares did you issue? 6,27,500, 6,72,500. Yes. So first part of the question we have done. They asked us to calculate the purchase consideration. We said the total purchase consideration is 13,000. And they said prepare a note of discharging the purchase consideration, because the question says ABX issued a number of equity shares. What is this 6,750? It is rupees in thousands. Understood, no? This was the doubt, right? This is rupees in thousands. See, we don't know. We have to take actually of ABX. Question is very silent here. So, have they told you anything on in the question about the face value of the ABX shares? So, we will assume to be 10 rupees. So, this is assumed to be 10. Now, I will show you another question. Now, there is the two different face values are totally different. One I will have different face value, another company has a different face value. For this, we will take 10 rupees as a face value. Are you clear, students? So, first part of the question, there are two things. They asked you the purchase consideration. 13,000 is the purchase consideration, but remember, leave some space, give the statement in the examination. And then discharge. Discharge should happen based on the net asset basis. Now you have to prepare a consolidated balance sheet of ABX. This is also rupees in thousands. So first we have got NCA, non-current assets. How much is my NCA, PP? Can you tell me? Simple, no? 16,000. Just add both the people. No headache here. Maybe I told you one more strategy. Write in the pencil and get those numbers. Your top priority should be to prepare the balance sheet along with the important workings. Don't spend time in preparing one schedule, table, statement of assets, liabilities. That is second priority. Second, we have got financial assets. We have got investment. How much? 1,600. We have got current assets. In that we have got inventory, trade receivable, CC. Again, no headache. Common combination is a very simple thing. Just add 4,800 and 850. 850. Done. We are done with the asset side of the balance sheet. Clear? Now I need to prepare equity. I should go to the equity side. Equity and liability. Equity share capital. So I will write note 1. So before I proceed note 1, can you tell me how much will be my equity share capital of ABX? Because they didn't tell you how many number of shares, but we calculated it. 13,000. Because purchase consideration we calculated, no, 6,72,500 and 6,27,500. That into 10 rupees face value. 13,000 is my equity share capital. You cannot issue at a premium. You have to issue at a face value only. Why? Because this is a business combination under common control. Clear, no, Prithvi? Yeah, we calculated, no. How many, see, it is the same like demerger. Turnaround limited. Yesterday we did. Turnaround issued its own shares. How many shares it issued? Say 10 crore rupees. At a nominal value. But balance amount was at a premium. That's fine. That's through court, demerger. But here when a business combination happens under common control, you cannot issue at a premium. So you will issue at your nominal value only, face value only. So 10,000 is my equity. Can you tell me what is my other equity? 5,750, because you are going to maintain the identity of both the reserves there. Retained earnings, general reserve, equity, whatever, capital reserve. They have already given one table there. So this is note number 2, because they may, in the examination, they may ask you prepare notes to accounts only for the equity and this, because you have to give certain disclosures there. Next, you have got non-current borrowing liabilities. What is your non-current borrowing liabilities? 7,000. So you can say note number 3. Why? Because there is a change in the nomenclature. It is not the same old 12% debenture. You issue, instead of that, you cancel and issue new one. Maybe the change in the terms, God knows. And the last one is the trade payable. Is it not simple? Are you clear, students? Sorry? Because business, see, like that I will also issue to myself, no, so many. It's like me issuing myself, no, business combination at the CFS level. See, your parent and subsidiary is considered as one. So any restructuring you do within, you cannot inflate your balance sheet. It is just a balance sheet to balance sheet merger. If it is under common control. The only thing is, if any third party comes, then fair value comes into picture. Goodwill comes into picture. At this overall level, that's what we have done yesterday. Net assets before demerger, net assets after demerger, 140, 140. You should get that effect. See, if you get any accounting benefits, no, then everybody will try to take the advantage of it. Everyone. Restructuring, no? It was restructuring, demerger. It might have happened through a court thing. We don't know. See, ultimately we will go with what they have given. In this question also, if they would have told that, because this also should happen through court only, amalgamation. See, there are two things. Next chapter we'll discuss. What's the difference between acquisition and amalgamation? Something can happen as per section, I think, 214 of the Companies Act. When you route it through Companies Act, or you can route it through stock exchange. It's called a takeovers. Followed, no? So that's what. We will discuss that in the next this thing, no, how it is going to happen, how it's going to work. That's what, see, it's very interesting students to learn law also. Because see, what we are learning law is not from a law point of view. We are learning law from monetary point of view. Can somebody take it? Because ultimately we should tomorrow deliver advices. Arey Baba, why you are taking this route? Take this route, no. And it is not illegal. Huh? You have to give one very good legal advice only. Because this will cost you more, because this has got an accounting implications like this has got a taxation implications like this. So don't do this through court, route it through stock exchange. Beautiful advice, and they will feel very good, and they will give you so much fees. That's why we need to have this integrated understanding of these subjects. That's what our understanding is a very niche: accounting, finance, law, audit, a very crisp things. Okay, are you clear about this? Yes, we will go to the notes now. Note number 1. Share capital. How many number of shares? 13 lakh shares at rupees 10. All are issued other than cash to AX and BX members. So this is the disclosure you need to give. And this is not relevant in the next chapter. Next we will do 110. It is not relevant there. But here it is relevant. And I have showed you in one of the examination question, correct? Specifically they asked, give me this note. And if you ignore this note, simply 1 mark you will lose. Then second, other equity. General reserve, 1500 plus 2000. We have already written the total value there. We will just plot the values inside here. P&L, 1000 plus 500. It is P&L is nothing but retained earnings, 1500. Investment allowance reserve, 500 plus 100. Export profit reserve, God knows what all, debenture, equalization reserve. You just name it, you club it, give it one single figure. And very nice question, because when you solve this question, next with the reverse acquisition, you understand very clearly the difference, how it is different from the reverse acquisition. Some time back we are doing normal acquisition. Then we went to the demerger, some 3 questions of demerger. Then common combination amalgamation with reverse acquisition. That's it. Hardly 38 questions we have got here. Around 40 theory questions are there that you leave. That also may come, but high priority should give for this. Huh? This chapter means every single chapter, but questions what we solve in the classroom. No? You have to hold. That's what I have given you, very limited number of questions. First round of preparations, at least 3 rounds of preparation should happen with this question, whatever I am going to give you, with the theory. Yes, the long-term borrowing, you just give one note, 12%. Yes, so we will move on to the second part of the question now. Okay, which is little tricky. Yes, friends. Now let us assume I am BX, you are AX. And I will give one proposal. I will say that, look, what is your business value? 11,000. You are AX, no? I am 14,000. So I will give one proposal to you. Let you bring your business, I will bring my business. We will merge it together and we will share it in the ratio of 50-50. Is it okay? Huh? Okay? Not okay? You will tell okay without any second thought. You will not think also. And you should not think also. Opportunities come like that. Moment somebody offers, give me. But do you think, I have put your Makmal topi here. Makmal topi. No. I am also smart guy here. See, when we talk about commercial there, both the commercial peoples are very smart there. Both people have done their research. Why on earth I should do this, accept this? I say get lost. Instantly without second thought. Because the moment I say, okay, I have lost my share value, no. So my question is, Can you suggest me one swap ratio? See, 50-50, not okay. We will put, you bring your business, I'll bring my business. Can you tell me one ratio which is okay for both of us? Okay, if I say 800-200, is it okay with you? You will say get lost. No, can you tell me which is okay for both of us? Just tell me how many shares in this ABX I will own versus you will own, which is okay. 5, 4, 40. Is it okay with you? Yes, Dhanashree? I don't know on what basis you said 540, 440. Yes. Or I can say 1400. Okay, how did you get 545? You took 56%. See, you 560, when did you say? Your mind was talking about 56%. Whatever, doesn't matter. 56%. So I can say 14,000 shares, 11,000 shares. 14 shares versus 11 shares. Ultimately, you are looking a post-acquisition stake. See how beautiful commercial common sense works. Before we solve the problem only, you came with these numbers. Okay, this is called a commercial common sense, correct, no? Yes. So how did we get this? Simple. We combined both of our businesses and we took a proportionate, say 14/25, which should be okay for both of us because there is no loss, no gain to anyone. Followed? Yes. This is okay. Now let us write the heading. Please write the heading. Assuming BX is a larger entity that is going to control, first, analysis of business combination. We will do analyze now. This is reverse acquisition as BX controls ABX. Thus, BX is accounting acquirer ABX is accounting acquiree. ABX here means AX. Because ABX there is no one, no. ABX is only a name, right? A dummy balance sheet. In that balance sheet, nothing is there. So here ABX you mean to say AX. So BX net assets taken. Who? BX is the legal acquiree, accounting acquirer. Understood, no? BX net assets are taken over at book value. AX net assets taken at fair value. That's why they gave the fair value. Last part of the question, they said fair valuation happened, no? But we want a fair value of only AX, not BX. Okay? So first we will write the analysis of the acquisition. This is the acquisition analysis. We'll write one working note 1, always post acquisition stake. See, if this is the reverse acquisition, since they didn't tell you purchase consideration, very first thing you need to see how much BX will maintain in ABX after acquisition. So percentage of stake of BX, since we already told BX is the accounting acquirer, how much he will maintain so that he will control. Because if you are wrong, if you do wrong calculation, say 50-50, then this ABX is going to become a joint arrangement. Then you have to see whether it is a joint control or joint operation. Joint arrangement. Then you have to see whether it is a joint operation or a joint venture. And if it is a joint venture, then Ind AS 28 comes into picture now. Investment in an associate. Structure, the way of accounting itself is going to change depending upon your analysis. That's why we cannot make effort to make certain wrong mistakes, no? It's a very risky job. Due diligence, mergers and acquisitions, sounds very nice. Oh, no, I'm working in mergers and acquisition. A small blunder, small mistake will ruin in thousands of crores. One EPS wrong calculation. 1 rupee can take 1000 crore rupees hit there. So how much accuracy we need to have? So what is the percentage of stake? It is 14,000 business value of BX divided by 14,000 plus 11,000. So they are going to maintain 56% post acquisition. That means they are going to give you ABX shares. Since you are an accounting acquirer, it sounds like you are giving your shares. What is the fair value of your share? Because when we see calculated the purchase consideration in the normal combination, we took our share and multiplied with our fair value, no? Only for NCI, see, there is an acquiree and acquirer. When you calculate NCI, say 20% into, you multiply with the share price of the acquiree. But when you issued the purchase consideration, your number of shares into your share price. No, what is your fair value? 10 is a nominal value. What is the fair value of BX? Okay, second, working note number 2. What is the fair value of BX shares? Do the calculation of fair value of the BX shares. Because you are going to issue shares. Now, who issued shares? BX didn't issue. ABX issued. But ABX fair value of the share is 0 because it's a new company. It's a sham company. Now, in effect, BX must have issued its shares. No. So, fair value is equal to 14,000 is my business value divided by how much is my number of shares? 700. Go and look into the BX balance sheet. How many number of shares they have? 700 rupees. 20 is my fair value. Yes, this is my first working along with the business combination, because these two inputs I need. The moment you say reverse acquisition, you require two information, only two information. How much that legal acquiree or accounting acquirer will maintain in the post combination entity. Second, what is the fair value of that accounting acquirer? Yes, keep this information aside now. Let us calculate the purchase consideration, because they said purchase consideration we have to calculate and we have to discharge. No? Write the heading. Second, calculation of purchase consideration. Under reverse acquisition, it is assumed that BX will maintain same percentage, 56% stake in ABX. If this should be the case, see, my existing number of shares are 700. There is one swap ratio going to happen. Understand, students? BX number of shares is how much? Right? BX limited shares, existing shares, how much? 700. Now I need to swap these shares with whom? ABX. And after this swap, in the new entity, my stake should be 56%. For this, can you tell me how many number of shares I should issue to myself or I should issue to AX? See, my post acquisition stake, okay, write this, BX limited existing shares, post acquisition stake in ABX will be 56%, which we already calculated, working note number 1. Now my only question to you is, see, my number of shares are 700, which I am going to swap with ABX. So that in ABX post my swap, I will be maintaining 56%. If that is the case, what should be the total shares, number of shares of ABX? That is very easy. Then you say, sir, very easy. 700 divided by 0.56 gives you total number of shares in ABX into, if you maintain 56, how much you will permit ABX? 44. So write the number of shares issued or shares issued to AX will be 700 divided by 0.56 into 0.44, 550 number, which is nothing but 44% stake. Have you understood? ABX will issue to AX. Now, is this the purchase? Is the number of shares? No, but what is the purchase consideration? Into 20. Why? Because ABX has got no fair value. BX has got a fair value. Since through ABX you are buying AX, for the number of shares ABX will issue, it will be multiplied with the fair value of BX. Why? Because ABX and BX are one and the same, no baba. From accounting point of view, you have to treat BX as an acquirer. Very complex. Simple. They made it complex. The whoever did this plan of acquisition of BX, no, ABX, BX and all, they made it complex. But we will go with the substance. So this is the substance. So you cannot get any advantage by doing this type of arrangement, at least accounting advantage. You may get a taxation advantage. You may get some other advantage, God knows what advantage. But definitely we will not permit any accounting advantage in this structure. So your face value multiply with the fair value. In your next line, you say fair value of the share is 20. So total consideration, how much did you give? 11,000, which is equal to its business value. What is the business value of AX? 11,000. So that's what you gave. By issuing them 550 shares, you gave them. Now you have to go to mergers and acquisition chapter of AFM. You see that. What they do there? You take their stake, you take my stake, divided by the total number of shares, swap ratio is decided there. Okay, post acquisition, they end up giving the same thing what they have got, unless there is a synergy. Yeah, there is no synergy. So what I will give you is your number of shares back to you, your worth back to you. Because in the combined entity, what is the combined value? 25,000 of the both the companies. 14,000 you, 11,000 AX. In this, what is the share capital? 700 shares belongs to, sorry, not 700 shares. 700 divided by 0.56 into 0.56. 700 shares belongs to BX, 550 shares belong to ABX. 56%, no? So plus 550, total number of shares is 1250. In 1250, 700 belongs to you. 56%. So what is your market price? 25,000 divided by 1250 of the combined entity. So your fair value is 20 rupees of the ABX as a whole into how many number of shares the shareholders of AX will have? 550, which gives their market value pre-acquisition. Perfect? Understood? Chalo, very good. So write note. Acquisition date, fair value of the accounting acquirer is generally used to determine the amount of consideration transfer. Why did you take 20 rupees? There you did a working note. But why did you take it? Because we will say that generally the acquisition date fair value will be considered of the accounting acquirer. That's why we did that working note there and we multiplied here. Are you clear? Yes. What should I do next? See, whatever they asked, we have done. They asked me what? Prepare a purchase consideration and a note of discharge. We said the purchase consideration is 11,000 Discharge is done by issuing 550 number of shares at a 20 rupees per share. Since it is a reverse acquisition, we have to calculate goodwill, no? Okay, right, goodwill. Calculation of goodwill. What is your purchase consideration? What is your purchase consideration? You have to think from a accounting, see, whatever ABX gives to acquirer BX, it's not a purchase consideration, no. Because here in reverse acquisition, ABX and BX are one and the same from accounting point of view. AX only we have to see. That's what I have told you in the theory, no, how this accounting is going to happen. Only that legal acquirer is there. Now, who is legal acquirer? ABX, AX. So you have to see what purchase consideration did you pay. 11,000 only you paid. You paid 11,000, no? Is there any NCI? No, because full 100% of the share capital of AX was taken over. Is there any previously held equity? No. Straight away write FVNA. What is my fair value of the net assets? Okay, for this book value of net assets, what is my book value of net assets? 9,000. We already did. Is there any fair value uplift? Yes, for two items. What is your ₹1,000 and 200? Correct? No. 9,050 plus 1,250. It comes to, no, I think one more item must be there. Fair value thing. 1 minute. Let me check. See, your net assets is 9,700, no? Of AX, sorry, 9,050, correct. And fair value adjustments you have got only for two items, 9,500 plus 1,300 inventory, so total 10,800. Its book value was minus 8,500 minus 1,250, 10,050, 1,050, 1,050. See what I did, not investment. It is the PP and inventory. See, there are only two items. You check what is the total fair value minus what is the total book value. That's the fair value uplift. Do you have any deferred tax? Have they told you tax rate? No, so no, not there. So a twist may come in the examination with somewhere noted. Same question, 30% is the tax rate. You are left with no choice. You have to calculate deferred tax on that. Do you have any assets which is unrecognized? In the examination, it make you both had got a brand. AX also had got a brand. BX also had got a brand. Whose brand you will recognize? AX brand you will recognize. And on that deferred tax impact is going to come. Simple. You should treat it, forget ABX into picture. This is a normal acquisition where BX is acquiring AX. Simple. Then you will not have any confusion at all. Only confusion lies in purchase consideration calculation. Here all same story. So we have got 950 plus 10,100. So if you minus this, you are going to get a goodwill of 900. So you have got the balance sheet of BX. We will prepare one. Do we need to prepare a journal entry? If I have to prepare a journal entry, what journal entry I will prepare? Net assets account debit 10,100. Goodwill debit 900. To equity share capital, how much? 550 into 10. To equity share premium 5,500. Okay, not required because it is okay here. Here only two things will come at a fair value. If you have to prepare a journal entry, they are not asked in the question, and it is very simple. There is no replacement award. You don't have all those headache things. What is that? Your all adjustment, deferred consideration. So this is a very simple journal entry where the credit will have two legs. Yes. Now we will prepare the balance sheet of Okay, we'll prepare the notes to accounts. 1. Share capital. How many number of shares you have got now? 12,50,000. 700 plus 550, no. That 11,000 in the previous question. 11,000 was under common combination. 11 lakh shares were under common combination. Last question, 11 lakh. Shares at rupees 10. Share capital. You have to write the share capital, no? How many number of share capital ABX is having now? 550 plus 700. You said 11,000 is the last question. Last question total purchase consideration was 11,000 shares, no? Something like that. 13,000 shares. 13 lakh shares or something. 11,000 is the purchase consideration amount. How many number of shares are there in ABX? You have got 2 shares, no? 700 shares to BX. In AX we have to write, and 550 shares to BAX. Because when it comes to disclosure, who is preparing this CFS? ABX is preparing, because legally he is supposed to prepare. BX will say, sir, Baba, I am a subsidiary. Can you force BX to prepare CFS? No. But in this CFS, the value should come as if BX is the acquirer. Second, you write other equity. Probably they may ask you this note. How much is general reserve? 2,000. Why? Because we will take only of BX. P&L 500. Investment allowance reserve 100. Export profit reserve 100. Do we have anything else? Share premium. We passed one entry, no, there. 5,500. And then the long-term borrowing, normal. Have you understood? Have you understood the difference? Since it is not a common comment, in the previous question, we just added both the people. In this question, since it is one of the parties, the reverse combination there, we will take the, because I showed you, no, between ABX and BX, it is like a common combination. That's why you take the reserves as it is. But between ABX and AX, it is like a normal combination. That's why you take their assets at a fair value. Calculate the goodwill for them. Securities premium, you will show it separately. Perfect, no? You understood very well. Yes. Because see, I expect in new syllabus they may ask you questions on this. Only one question has come till now. Yes, now we will prepare the balance sheet of ABX. See, one thing learning is procedurally. You practice 4 times, you without understanding, you will understand what it is. Second thing is going in depth, what exactly it is. So that now you are ready, because in the examination suddenly they will give you a brand. Whose brand you will consider? That requires conceptual knowledge. Procedural person will go on there. They will not understand only because in the study material brand was not given. That is called a conceptual understanding. Okay, so first thing I will start with the non-current assets. So in this we have got PPE. How much is my PPE? I will write here only in the bracket. 9,500 plus 7,500. Fair value of AX, book value of BX, which is 17,000. This is coming from the balance sheet as it is. This is coming from the opening journal entry, goodwill calculation. Then we have got a goodwill, 900. We have got a financial assets. In that we have got investment. See, investments are not fair value. So you take the book value of 1,050 plus 550. Because both are not fair value. Then you go to the current assets. In current assets, first you have got inventory. From the balance sheet of BX, you take as it is. But for AX, there is a fair valuation. So you take the fair value, 1300 plus 2750. Have you understood? 4050. Second item, you have got a trade receivable. 1800 plus 4000, both are at book value, no headache. CCE 450 plus 400, both are at book value, 850. And you got this balance sheet, 30,200, asset side of the balance sheet. Now, certain things, adjustments are there here. One, goodwill, which was not there in both the balance sheet. Some fair valuations, which was not there in both the balance sheet. Correct? Where is the second leg of this fair value uplift? One fair value uplift, one leg is sitting here. The second leg will go to that opening journal entry. Opening journal entry, you will check, no? Equity share premium came there. Liabilities came. So I cannot pinpoint and show you exactly the second leg of it. Same problem I'll face in the next chapter also. But overall level, you should know the impact. If the balance sheet doesn't tally, you should be able to go back to your goodwill working, take the balance sheet of BS and see exactly which one you didn't plot. Balance sheet didn't tally, this should not, you should not say, at least for me. So equity share capital, how much? 12,500. We have already done that. Because from the journal entry we have taken that. How many number of shares? Because I have taken the equity shares of our BX as it is, plus additional number of shares, split it into share capital and this. Then other equity, 8,200. Out of 8,200, that 550 into share premium is also sitting here. Rest everything is belonging to the share balance sheet of B, who is already a tallied balance sheet. Then I will go to non-current liability, 12% debenture, 7,000. Current liability, trade payable, there is no fair value adjustments. So straight away I will take both the values. Yes, my balance sheet is complete. Are you clear, students? Understood? Yes. So this question came in your December 21 examination. Sun and Moon amalgamated, new company was formed called Sun Moon Limited, AXBX, ABX. Property, plant and equipment, everything they told you, values and all. Equity share capital, face value 10 rupees only they told. Borrowing, financial liability, trade payable. Notes to accounts also they gave. Sun Moon Limited issued a requisite number of shares. So they didn't tell you exactly how much. That's what you need to calculate. Also new debentures were issued. Compute the purchase consideration and advise the discharge thereof, preparing a note. So you have to calculate how much is the purchase consideration, note you need to do, and draft the balance sheet of Sun Moon after assuming that the Sun Moon and Moon are not under common control and management of the larger entity out of Sun and Moon will take over the control of Sun Moon Limited. Now who is the larger entity here? In the study material, they told you BX will take over. Here they say, look, whoever is larger, no, they will take over. They didn't tell you exactly. Who is large? Sun is large or Moon is large? In physics language. Sun is large. Moon is small, no. Sun is so big. Here, who is large, who is small? On what basis you will figure out who is large? Huh? Fair valuation. You see the catch, no? In the exam, you see how beautifully they told. Study material straight away BX, no headache. Now you have to figure out fair value of the assets. Sun Moon were already given. PP inventory, same fair value of the business. Okay, yeah, please pause the video, students, and do the working. Let us compare the answer. No, I don't want to discuss who is larger, who is smaller. See, every single student faced this problem, whoever attempted, because this is the only question came till now in the previous attempt related to reverse acquisition. Till that time, no reverse, and this is the only one question which was there in the study material also. So now you think that you are sitting in an examination hall, you take your whatever decision you want to take. Since you have understood how to do, it's not a common combination. So first part you ignore, just work for the reverse acquisition. Yes, students. So pause the video and do the working. Yes, students. So you have seen, no? See this question. Actually, there could have been more complications like bringing the deferred consideration contingent, and we really don't know how to account. That is real life part. Okay, and your one more question, like recent examination, it came difficult. Yeah, okay. But if you look into the probability, in the past, what is that called? If it is the 11th, this is the 11th attempt. In the past 10 attempts prior to that, questions were all like this only. No? It's only one attempt, one time they asked. So go with the probability. So you have developed, rather than deterministic thinking, no, develop a probability thinking. Like if you leave this, discount that question, or so many other questions are there, no. You say, sir, only 50% came from the study material. See, again, 120 out of 120 marks, they can give it from the study material only. But one twist here, one twist there, no, will ruin everything. Even though you feel that I'm not telling you, I'm just demonstrating to you every time that even it can be an exactly same question with one twist, they can give you 0 marks. Totally one question is newly framed, not there in the study material. You can score out of out. Followed, no? So ultimately, what is important is that confidence. You should feel that a CA final exam is simple. That's what that feel should come to you. If you think that CA final exam is like one demon, this thing, it is going to become difficult. You should feel that simplicity. At least I could see really it is simple, Baba. Because if somebody want, they can really make it complicated, but they are not doing it. So it is within our reach. Practice and alertness. Somebody is well practiced, but drinks and drives. What is the use? So alertness also should be due diligence, we call that. We should always have that along with our skills. When our mind in the examination hall, mind should be there on the questions. Should not wander here and there, at least at that 3 hours. Okay, so let us compare the answers. Okay, who is the accounting acquirer here? Moon. Very simple, we can see it from here only, no? Why we have to see all other instances? Just look from the business point of view, who is the biggest one? The Moon is the biggest one. Yes, first thing we will start about the determination of larger entity. I don't think so, because this can be one twist in the examination. It may fetch you 1 mark because in the question they didn't tell you exactly who is larger. Maybe the examiner is expecting that you will write who is larger. Have you written who is larger? No. Some students might have written, some students may not have written. I will give 1 mark for this. Some students would have lost 1 mark for not writing. They will tell, sir, who asked in the question? Or I don't know. Maybe this is not relevant also because they didn't share the answer keys. No. But since the question was silent, some students could have attempted telling, look, Moon is larger. Anyhow, that analysis would have come in your determination of that reverse acquisition and all the stuff. And how do you say Moon is larger? Because you calculated taking their business value, you told 44% and 56%. So this is one twist. My theory says that I say I do not want to give you full marks. So it's the 14 mark question. So even though 14 out of 14 you have run perfect, everything is perfect, still they may deduct 2 marks for not writing this, which they didn't ask you also in the question. Leave it, we will discount, no problem. We will proceed further. In case of reverse acquisition, Moon is a bigger size. I think this you must have written. Reverse acquisition is happening. We will take their values at a historical cost. Sun Limited values we will take at a fair value. I hope this you must have done. Then computation of the purchase consideration. We will say that's post acquisition stake. They 56% they want to maintain. That's why 11,000 shares they are going to issue. So total purchase consideration will be 20 rupees per share, which is separately calculated here only. They didn't do a separate working, into 11,000 shares, 2 crore 20 lakhs. Did you get this purchase consideration? Step number 2 in the previous working. Then they prepared a goodwill calculation. So they took over all the net assets where 2 items were taken at a fair value, and the purchase consideration they deducted 18 lakhs. They got the goodwill. Chalo, we are very near, and you have already scored good marks by now. Irrespective of 1 mark, 2 marks, there you lost. Then you go for the balance sheet. See, in balance sheet they also added here. PP comes to 3 crore 40. Goodwill is 18 lakhs. Investment is 32. Inventory is 81. Trade receivables. And so only 2 items your fair value adjustments will happen. Rest everything is same. So total of the balance sheet 6 crore 4 lakhs. Any mistakes up to here? Any goodwill calculations, purchase consideration calculation? Very good, nice. And you have done this in the examination also, fantastic. And you know that when you see 56%, it comes to you. Oh, it's then 56%. Yes, Vidya, anything, any mistakes? You added a? How did you get 170? From where did you get 170? Have you done the fair value adjustments? So you should have taken 150 of moon, 170 you should not take. Why? Because you have to take a fair value. What is the fair value? At the end they have given 190. Alternatively you could have done 170 plus 150 plus 20. It tallied because see, beautifully drafted. Both are more by 20. Your book value was 170, fair value is 190. Book value is 150, fair value is 170. So I think you have taken the moon's fair value. But it tallied. Luck. Good luck, no? Because both the fair value increase was 2020. What if one of the leg it was 22? Your balance sheet would have been different by 2 lakhs. Anyhow, I think they may give you marks for this by looking at what you have added. Your marks may get deducted if you think, because see, they have done, I cannot design one question paper which ICA has done, that I realized by now. Very intelligently, keeping so many things in mind, they design this question paper, which I cannot design, definitely. So they apply their mind in every single number. Okay, other than that, fine, right? Everything is fine. You understood your mistake. Equity share capital 2 crore 50, other equity 1 crore 64 lakhs, borrowings, trade payable 6 crore 4 lakhs. I think this should be okay. Then I'll go to the share capital. You have got 25 lakh shares, 2 crore 50. General reserves of moon, you take everything plus share premium and the long term bonds. You will not take the reserves of sun. What happened? Share premium, because what is the purchase consideration issued? You got that. But you cannot issue more than 11 lakh shares into 10 rupees. 11. What is your purchase consideration? Your purchase consideration, what you got, 2 crore 20. Out of your 1 crore 10 lakh is the face value, no? Again, they may deduct the marks, because this is the main working which is required. See, okay, that's why. If you attempt out of 14, somewhere 10 also if you are scoring, very good number for me. But don't make a blunder somewhere at the beginning, so that you spend time, you don't get anything or get very small amount. That is not acceptable. You spend time, get good thing. At least some 70% you should get. Don't expect 100%. I say shrewd enough to deduct here or there. Okay, students, understood? Of a sun, because you issued sun, shares at a premium. Purchase consideration was 2 crore. Balance sheet belongs to Sun Moon. That's what, no, it's an irritating thing, Baba, to explain for anybody in the, not here in the classroom, outside, because that irritation you will come to know in the next question. This question was very simple enough. You read the next question, then you understand how much irritating it is. Yeah, unless the question tells you something, see, just follow a practice. If the question gives you in some values, try to follow that values. If they give you in thousands, do it in thousands. If they give you in lakhs, give in lakhs. But my suggestion, if they give you in full number, do the full number only. Don't write rupees in lakhs and convert 250 and all. This is my opinion. I don't know how it works. Sometimes they only will tell you. Not here, but some other AFM and all. But my suggestion, better you go with this thing only. Practice sake, you do it. Followed, no? Yes. Next question you see. On 30th September, entity A issued 2.5 shares in exchange of ordinary shares of entity B. Oh, this time only 2 entities are involved. Not AX, BX and ABX. A acquired B. How? By issuing 2.5 shares. Number of shares also they told. Previous question we had to calculate it. All of the B shareholders exchange their shares in B. That means now B has become 100% subsidiary of A. Therefore, entity A issues 150 ordinary shares in B for 60 shares of B. Dear students, kindly. See, understand, students, this question is different, which has not even come for exam. In this, already there was one entity B, whose number of shares were 60. Now, A took over them and issued 2.5 shares for every single shares. So, how many shares they issued? 150 number of shares they have issued. Now, how many A had? We'll see. Followed, no? In the previous question, we had to calculate it. In this question, they only told you legally how many number of shares were issued. The fair value of the ordinary shares of B is 40 and quoted market price of entity A is 16. That means both are, A is listed entity with the fair value of 16 rupees, a very small company, but B is an unlisted company. That's why they gave you the fair value. For them, the market price, quoted market price. So this is a scenario where a public company was acquiring a private company, which itself gets acquired, reverse takeover. I told you, they wanted to list and all, that type of scenario. The fair value of entities A, identifiable assets and liabilities are same as their book value. Okay, no headache here. Except that the fair value of entities non-current assets is 1500. That means, why they have to tell me entity A's fair value? Acquirer's fair value, why do we need it? Somewhere you should get a doubt now by reading this question. The statement of the financial position is given. You see that, when you see here heading, they say legal parent accounting acquiry. You understand this is the reverse acquisition. Forget if this was not there. You go further, you see the equity shares. How many shares they have got? 100 shares. And what must be the face value? Rupees 3. That's what one strange. And this question is coming from IFRS. In IFRS standard, they have given this question. Copy pasted, dumped here. And to make students' life easier, they gave one more example. Same question, modified it. Now 60 ordinary shares. What is the face value? Rupees 10, 600. So out of, you have got 100. See, understand. How many additional shares you issued? 150. How many total you had? 250. So how much your post acquisition stake? 60%. That means this entity B, after the business combination, holds 60% of entity A. Not entity B. Entity B's owners. Previously, the structure would have been like this. There is Mr. X. He owns entity A, say 100%. Now the structure is Mr. A will have B limited, A limited, B limited, and he will only hold 40%, and B's earlier owner will hold 60% of it. This is like an acquiring an acquirer. Reverse acquisition. Acquiring, acquirer. Here also in the bracket only they have told me that is a legal parent, accounting acquirer. Even though they would not have told you, you would have understood from here also. One more hint for you, they gave you the fair value of entity A, who is a legally an acquirer. Accounting wise is an acquiree. Now assume entities B's earning for the annual period ended were same. Is this statement there? I think they must have removed in the new syllabus. EPS calculation. In your question it is there. Yeah, I think in the new syllabus they have removed this. Anyhow, we will solve that. Entity B's earning, and you give low priority. You may not understand what we are doing here, EPS, but give low priority. Just for your academic interest, I am showing you here. I think they have removed it from the new syllabus. Last year, entities B's earnings they have told you, and the consolidated earnings, assuming that there were no change in the number of ordinary shares issued by entity B during the annual year. So this piece of information is for EPS calculation. We will look it later. Now not required. Calculate the fair value of the consideration transferred. How much is, what is the purchase consideration? You will tell, sir, 150 shares are issued into 20. Fair value of A. Need not be. This is legally, no. But accounting A. What is fair value of B? 40 rupees. They told you, no, first part. Fair value of A is how much? Oh, sorry, not 20, 16. If it was a normal combination, what is the purchase consideration? Is it cash issued? No. Shares issued? Yes. How much? 150. A gave 150 to be the shareholders. No. Into whose fair value I should multiply? 16. A's ordinary share price. So 150 into 16, you would have said 2400 is the purchase consideration. That's what acquirer is A, no? Normal combination. But in reverse combination, we have to take the fair value of the acquiree, multiply with the number of shares. Which one? Not what is actually issued. What was given to A. So post combination, how much you give to A, that's what we need to check. Accounting wise, legally it is different. Here there is a confusion. Don't say that, oh sir, 100 shares they have given. No, not like that. It will work like that differently. Okay, so we'll solve this. Analysis of the acquisition. First write analysis of the acquisition. So we'll not write much theory here. It is the reverse acquisition. This is a case of reverse acquisition. Just write one sentence, enough. Anyhow, while practicing, you can always practice and write all these stories. And because of the reverse acquisition, now you will write that B limited fair book value will be taken, A limited fair value will be taken, B limited reserves will be taken. There is goodwill will be calculated considering A limited fair values. All these stories you will be writing. Who is the accounting acquirer? Who is the accounting acquiree? But you need not write it because already they have given in the question there. Yes, now we will calculate the post acquisition stake. Percentage of stake of B in A. How much? 60 into 2.5 is the number of shares issued divided by 100 plus 60 into 2.5 or 150 divided by 250. 60%. Do I need to calculate the fair value of B? Not required, they are already given in the question. Otherwise, we calculated a fair value of B because we want a fair value of B now. Working note 2 not required. So straight away we will go to the calculation of purchase consideration. Okay, right? Under reverse acquisition, it is assumed that B Limited will maintain same 60% in A Limited after new shares are issued. So we'll write one statement. So how much is B Limited shares? 60. Existing, because see, A acquired B. No, B acquired A. If we have to treat it like this, from an accounting point of view, if it was a normal acquisition, who issued shares to whom? If it was a normal acquisition, who would have issued shares to whom? B would have issued to the shareholders of A. If B had to issue, how many shares B had existing? 60. How much is post acquisition stake B would maintain after it issues shares to the owners of B, A? 60%. So therefore, shares issued to A Limited owners, how much? 60 divided by 0.6. This should have been total of B's share capital into 0.4 gives you 40 shares. So if it would have been a normal acquisition, B would have issued 40 shares. Therefore, total purchase consideration is equal to 40 shares into, what is the fair value of B? 40 rupees 1,006. This is the purchase consideration. Legally, you might have given anything. Legally, you will tell, sir, I have issued 150 shares into 1,016 rupees per share, 2,400. No, 2,400 I will not consider there. Because 2,400 is only for to whitewash, somebody has issued it. It is a whitewash there, 2,400. 1,050 share, 150 shares into A's fair value 16 rupees. Is the whitewash. Accounting wise, B has given a consideration of 1,600. Note, same note. Fair value of B Limited will be considered for purchase consideration in reverse acquisition. Who is the accounting acquirer? It may look very strange to you, but that is accounting. That's why we call them accounting acquirer. Now we will calculate the goodwill. In a business combination, you are going to do acquisition date, fair value of the accounting acquirer to calculate the purchase consideration, goodwill calculation. So what is the purchase consideration? 1,600 minus FVNA. How much? What is the book value of net assets of A Limited? Sorry, total net assets, book value, fair book value of the net assets of A Limited. You check, no? Book value of the net assets of A Limited is the question number 37, right? You just look at this. Equity share capital is, no, 1 minute. This is question number, this only, right? A Limited book value is 800, 1,100. Is there any fair value uplift? Yes, fair value uplift. They said no. A Limited's fair value of identifiable except non-current assets, which is 1500. What is the book value of non-current assets? 1300. Book value of non-current assets 1300, which is valued to 1500. So 200. So 1300 is this. Alternatively, you could have plotted individual values. You could have gone for individual values. You get the same 1300, like 500, 1500 at fair value. Rest everything is the book value. Your choice. You should have done that. Clear? Perfect? Yes. Now we will prepare the consolidated balance sheet. Non-current assets. How much? No PPE breakup and all. See, 1500 belonging to A plus 3000. Exactly. Fair value of A, book value of B. 4500 crore. Just look into their balance sheet. Then goodwill. Before current assets, goodwill come. For this, you have to follow the schedule 3 format. 300. Current assets 1200. Now comes the catch, equity. Because equity, their face value is 3. Here something 10 rupees face value, something we have done. So you have to write equity share capital. How many number of shares they have got now? 250 legally. So and what is the face value? 600 of B. What is the face value of shares of B? No. You look into the share capital of B. 6 ordinary plus 1600. What is this 1600? Purchase consideration what you have issued, which includes share premium and face value. Generally, we used to give a breakup, no. But here we cannot give the breakup because the face value of 10 rupees, ours is 10 rupees, theirs is 3 rupees. So which breakup? That's why we have to give a note at the end. So total purchase consideration is 2200. Other equity how much? Only B. Generally, we would have added, if we would have given the split here, 1600, if we are able to split, this much is the face value, this much is the share premium, problem is solved. We would have share capital face value this much, and the balance amount we would have added to other equity, like just like last problem. But we cannot do it here because the face value of them is 3 and ours is 10. So other equity we will write 1400 only, and the non-current assets and liabilities will be this. Then we have to give one big note. Okay, are you clear, students? Easy, no? Reverse acquisition. Yeah, it's just because of the face value is different, no? We are not able to bifurcate. If both were same, 10 rupees, 10 rupees, yes, we could have effort, we can try to bifurcate this 600 is going to come. And again, whether 600 is going to come or not, how it is going to come, that is the parent, they need to explain it. That's what we have to give in one note. And this is a very strange question coming in IFRS, not our institute's question. If you open the bare standard, you see this example. Okay, write one note there, notes to account. The issued capital in CFS is rupees 2200, which is obtained by adding. We got issued capital 2200. We have to explain this, no? Because it's a confusion there, it's a gray area now. 1. Issued capital of B Limited, which is 600, and fair value of consideration rupees 1600. Then one note we need to give. However, equity structure appearing in CFS in bracket type and number of shares must reflect the structure of legal parent A. Value should be this, and the type and number should be whatever, in whichever jurisdiction, whichever country, how the A presents, it should be as per A. Then don't ask me now how, because in India, I don't know, we are not dealing with this type of thing. Intentionally, one complicated problems are given, and they gave a note. Don't bother now splitting into number of shares and all, they are not required. In examination, if this question comes, you have to do it this way. You have to give one total value, purchase consideration you add, and say, look, we have added both like this. This should be the value, but how it should be presented, number of shares, face value, authorized capital and all, that the management of the A Limited had to take care. This is as per the legal structure of A. So to solve and explain this, one more question came where face value of both the companies were same, which is exactly same. That's what I think in the examination that example question may come. Okay, now let us discuss about the EPS part. They said what? Assume entities B's earnings last year were 600 and consolidated earning for this year is 800. Now why they have to give me B's? They should have given me A's, no? Because when you have consolidated, who is A here? A is nothing but B only. A is only name in the balance sheet, but the values of the balance sheet should come from B. Assuming there is no change in the number of shares, that means the number of shares were the same from the last date to the reverse acquisition date. So we have to calculate EPS. Okay, right? EPS. EPS in A Limited, in substance B Limited. So how many number of shares were outstanding this year? 150. Which A issued to B, means B legally having it. Like for example, I can say 150 I can compare to 60, my existing holding. Previous year 150, because in CFS I am preparing first time. Since B was already there, B's values will come as a last year figures. Because B is a parent, no. In substance, B is a parent. Legally, A is a parent. Now, how much shares issued on merger? 100 into 3 by 12. You issued 100 to A because 100 was already there legally. But it was outstanding when? Only 3 months, because not for the entire year. This is coming from EPS. I think in the inter-level you have done that. I need to calculate it, weighted average number of shares, VANs. The merger happened just 3 months before the year end. So 25. Last year not there. So my total number of weighted average number of shares is 175, 150. This year earning is 800. Last year earning is 600. So my basic EPS is 4.57 and 4. Now all the investors will shout. They say, what is this? Are you mocking accounts? It's like a mockery of accounts, no? Whatever comes to them and they are doing, no. This is what accounts is. We will not permit to take A's value. Legally, 150 number of shares you issued, no, it is what you had already. Clear, students? Yes. Yes, move on to the last question. Balance sheet of A and B immediately before acquisition they have given, and numbers you see, no, I think is similar to previous question. Just see, numbers are similar, no? Everything is same except here, if you see, 30,000 shares, 300 and 600 are there. Same like previous question, but face value is 10. Good. Now non-current liabilities, current liabilities. On 31st of March only, this is when, I don't know when they have given, A issued 2.5 shares for B in exchange of their shares. Entity A issue 1,50,000 shares, which is 150 shares, in exchange of 60,000 shares and 100% owned. The shareholders of entity B own now 83.33% legally in the combined entity. The directors B appointed 6 out of 8 positions of the combined entity on the board. In accordance with Ind AS 103, legal acquiry, the accounting acquirer, entity A is the legal acquirer. They are telling it's a reverse acquisition. And one more thing, this example, they didn't prepare the balance sheet. They have done only purchase consideration. So what I think, they will give you this question where purchase consideration you have to do as per this, balance sheet you have to do as per the previous one. Because same numbers, no? The quoted price of entities B's shares is 105 and A's shares is 20. I am interested in this. Assume the fair value of A's assets are same. Okay, good. No change in the fair value also. At least they told you somewhere in non-current assets. Ignore the tax effects also. Obviously, no. Even though say consider tax effect also, where is the deferred tax here? No need. So calculate the fair value of the consideration transferred, measure the goodwill and prepare the CFS. Okay, so we'll do quickly. Solution 1, analysis of the, will not talk much. Analysis. This is reverse acquisition. B Limited is accounting acquirer and A Limited is accounting acquiree. Enough. Rest of the story not required. In the given question, they only told you post acquisition stake. What in the examination they will not tell you? Like if you look at the previous thing, they didn't tell you. We did this 150 divided by 250. But here the number of shares are different. No, previously it was 100 shares. In this case, it is 300 shares. So we will always, okay, this is the same theory. We will calculate the post acquisition stake. So post acquisition stake of B Limited is equal to how many shares you issue? 60,000 into 2.5. In the examination, you can skip. If they already give you 83.33%, you skip this. Divided by 30,000 shares they already had plus 60,000 into 2.5. See the difference between this question and the previous question. In the previous question, since the face value was 3, it was 100 shares. In this question, the face value of A is 10, it is 30,000 shares. Because of this, from 60%, it is increasing to 83.33%. Have you understood this? The difference between this and the example question? All difference because of the 10 rupees face value. And see, if in the examination also, they will give you 83.33 or whatever percent. Don't do this calculation, not required, no. Already they only told you. Next, we will move on to the calculation of the purchase consideration. What is your B Limited shares? 60,000. You'll write that some small theory. It is assumed that B will maintain the same percentage of stake in the post acquisition of combined entity. What is post acquisition stake? 83.33%. Therefore, shares to be issued to A, how much? 60,000 divided by 83.33% multiplied by 16.67%. So you get 12,000 shares. Have you understood? Same question, Baba. Except the face value 10 rupees. So what I think, high probably they may ask you this question in the exam. Alternatively, they may repeat the same question of that AX, BX. Be prepared for both. Now, therefore, PC is equal to 12,000 number of shares into, please tell me, into what? Huh? Yes, Vishnu Priya, what is your opinion? 12,000 number of shares into what? Kriti, Vidya? No, I want to take everybody's opinion because I would have told you, please do it yourself. 105. Who the fair value of B. Yes, students. So now, please pause the video. Right, you can write the same note. Okay, so fair value of B is considered because he is an accounting acquirer. Prepare goodwill and the balance sheet. Have you understood now up to here? Yes, Mr. Priya, are you clear now why we have taken 105? And for this we have given a note here. We will, since the accounting acquirer is B Limited, we will take their fair value. Yes, so please pause the video, students, and prepare goodwill calculation and the consolidated balance sheet. Yes, students, so we'll compare the answer. I am damn sure everybody must have got the purchase consideration, goodwill correct, which is 1,60,000. Very easy, where fair value changes are not there. Book value of A minus the purchase consideration. Now we will go to the consolidated balance sheet. First thing, you have taken non-current assets 41 lakhs. Goodwill you have taken 1,60,000. Current assets 14 lakhs. Add both. Everyone must have got this 6,60,000. Now comes equity share capital. I want to know, what did you say? Did you split into equity share premium and all? See, I don't know, students, how it should, because for me also there is no guidance. I will say equity share capital is, see, 1,80,000 shares. How did you get 1,80,000? How much they had? A already had. How much A had? 30,000, no? 30,000 shares A had. How much they issued to B? 60,000 into 2.5, 1,50,000. So they have got 1,80,000 shares of 10 each, but its total value is 18,60,000, which is nothing but the face value of 6 lakh plus the purchase consideration. On what basis I did? Because I have seen one of the similar question of the study material there, where institute has followed this approach. And they gave a note that number of shares and the value and all depends upon legal structure of A Limited. And why I have to apply my mind and split into share premium and all? Because legally how it should be, share premium is not my choice, no baba. It is governed by a law. Anything I can go and put there? No, I should put as per the law. So whether law is going to permit me this, that I have to check. I have to take one legal advice there. So I would have done this way. Other equity full 17 lakh only I would have taken. And why I am taking this? Because I am seeing one case where institute has done that. I have understood, no? That's why they are very chalu. They didn't give you the balance sheet for this example. In the exam, they may ask you this with the balance sheet. Are you clear now? Yes, Dhanashree, clear? This is what you are asking, no? Yes. So non-current assets 15 lakhs, 6 lakh. Now you have to give one note that 18,60,000 came from two sources, where share capital of B is 6 lakh and the fair value of the consideration 16. However, the structure, how many number of shares, what is the issued number of shares, type of shares, all these are going to come as per A Limited legal structure. With this, we are done with the one beautiful chapter, loving chapter called business combination. Understood clearly?